Go?
I am.
Okay, great. So welcome to the spring semester of our risk seminar. Glad to see so many of you back. And today I'm delighted to introduce our speaker, Stephen Thorley, whose work I've been following for a decade, maybe 2 decades, a long time. It's always great and very useful to my own work. So Stephen, thank you. And thank you to Roger Clark and Horinta de Silva too, for all your great ideas. Stephen's at Brigham Young University, and today he'll talk about risk management and the optimal combination of equity market factors. So I will go on mute and let you get started.
All right. And I guess I'll start with a little more introduction. It turns out that I had intended and have retired from academia and BYU. I did that last year, not really with the intent to retire, but to do other things, more consulting with Roger and Harin, who Lisa just mentioned, a number of boards and that sort of thing. But because of, I guess, the COVID-19, the virus, somebody couldn't teach a class at BYU, and so I'm actually now back teaching. I taught specifically yesterday investments in the MBA program there, and those classes are Monday, Wednesday. So I'm sort of back in terms of academia, and at the same time, the firm that we work with is part of Wells Fargo Asset Management, and that firm is being in the process of being sold by Wells Fargo, the bank. We may find out here in the next week or two exactly who they're going to sell it to and how much. But also because of that, I'm doing a little bit less of some of those other things. So that makes it nice that I have a chance to talk to you folks. My understanding is this is a risk management seminar, and so let me just start by, and this may in fact be too high level in review for a lot of you, but what I'm going to talk about is risk management, specifically in the financial markets, and even more specifically, risk management in terms of equity market factors. This is based on a paper that we published, I and my 2 co-authors, you can see on the screen, published last year in the Financial Analyst Journal. I am, I guess, full disclosure, I'm also a co-editor of that journal, which makes for some interesting conflicts of interest, which Lisa would probably know about. But given that we did get it published, that journal does now require 2 peer reviews, and we were grateful we got through that peer review process and got this paper published. So risk management, and I guess in the broadest sense of the word, we would be talking about ways to deal with risk in a corporate setting, risk in investments, and then again, more specifically, risk in the financial markets here. So let's advance the slide one, and this is just a typical citation of references regarding this research work. If we can skip past those, we'll come to this slide here, which is, I think, conceptually the most important, probably of the entire presentation. So what we're looking at here is a very simple, almost conceptual equation to discuss how you might manage risk in the marketplace, in financial markets, stocks, bonds, portfolios, more likely. And in a minute, we'll see specifically factor portfolios. But for now, what you're looking at is even so simple as to, like say, just be a concept. On the left-hand side is market exposure. There's a subscript T, which means the market exposure at a specific point in time. And the assertion of the equation is that you should, and I say should as economists, we don't like to actually say things like you should do this. It's more like this is what people are doing. But in this context, you should adjust your exposure to the stock market, say the S&P 500, based on a targeted volatility, a constant volatility number. You might choose a number like 15%, which is a typical volatility number for I'm thinking the US stock market, S&P 500. And then in the denominator, you would put a prediction of what the risk of that market is going to be. What you see there is VIX, and then a subscript T minus 1. That VIX is the VIX. It's a volatility index. It's an actual financial security that measures the expected volatility of the market, and in particular the S&P 500, based on options on that index. And so the equation says you should, or you can, adjust your market exposure based on a targeted level of risk, and that divided by what you predict the risk of that market to be will give you the proper exposure. And if you do this, then say month to month to month, at the beginning of every month, you would change your exposure to the S&P 500. And change your exposure means you'd take if that exposure number turns out to be 0.6, then you would have 60% of your portfolio in the stock market and the other 40% in a bank or some risk-free account. And then the next month you redo it, and it may come out to 0.8. And if it did, then you would put more money into the stock market. And if it came down to a lower number like 0.4, you'd put less. The slide says, for example, actually, if you wanted to get a 10% risk level, then again, you would put that into that constant vol number, and that would stay the same month by month. And you would change the VIX number, the predicted risk number, and it doesn't have to be VIX. It could be your own private prediction of what the risk of that market's going to be. The real sort of amazing thing to financial economists is that works. And when I say that works, it works in two ways. First off, it works in the sense that you actually would get that targeted amount of risk on a constant basis. If you were just to buy the S&P 500, the risk you have one month could be double what the risk you have the next month. Or famously, the market was extremely volatile last year. And once the virus hit, we knew it was going to be volatile. The VIX numbers shot up, and sure enough, it was a volatile year. So there are whole periods of time, years at a time, when the market is more volatile than at other periods of time prior to the virus and after the 2008 financial crisis. There were several years where the market risk, as measured by VIX, was quite low, as low as 12%, 10%, 9%. And so this works. This works in the sense of leveling out the volatility of the market over time, and the investor then gets a constant level of risk. But it also works, and this is more the point of the paper, it also works in the sense that you actually get a better return for risk. A higher Sharpe ratio is the way we would say it. That both that it works in terms of leveling out your risk over time, but also that it actually adds value, is not new in this paper. And in fact, we had to reduce that to just a couple of paragraphs as an example in this paper because it had been so well documented and published. Although prior to, say, 4 or 5 years ago, most financial economists would have said, no, you can't do that. You can't do that, meaning if you can't time the market, you can't adjust your exposure and add value, or if you could, it wouldn't be this simple. But now there is a sense that it is. And then if we'll advance the slide, the point of the paper is to apply that same methodology to what are called factors in the marketplace, or factor portfolios. Although as I look at the new slide here, this is then the demonstration of that process on the market. And in fact, I don't know, I guess this is a seminar, not a class, but if you wanted an example, something to do as a exercise for the reader, I guess, it would be to replicate this slide. You could do that by going to the internet, downloading all the VIX data that is available, monthly observations of what the VIX number is at the beginning of each month, and at the same time download S&P 500 return data. I'd say just the SPY, the ETF that tracks the S&P 500. Put that into a spreadsheet and then try this, and you should be able to exactly replicate this result. Let me say this result again as we're looking at the slide. We take the market, which has a Sharpe ratio over this period, 0.544, and we're increasing the Sharpe ratio to 0.626. And that is a substantial, economically meaningful improvement in performance, not by just trying to get a higher return, but simply by targeting a level risk number. Maybe one other thing on this, and then we'll move on, is that one of the things we also did in this paper, though, is to sort of resurrect a measurement, a rule that I think had been lost for 20 or 30 years, and that's down at the bottom. We call it the Trainer-Black rule, and it's a way of measuring the increase of in a Sharpe ratio, or almost equivalently what are called information ratios in active portfolio management. So down at the bottom, you see how much bigger or better that Sharpe ratio is by virtue of that risk management process. Let's go to the next slide. So the main empirical point of the paper then is to...
I'm sorry, can I ask a question? Did you take into account transaction costs in that analysis?
The direct answer is no, not in the example that we just showed on the market in the S&P 500, no. Although that was sort of intentional. The notion was, in that instance, if an investor were going to really try and do it, it's almost cost-free to adjust how much you have in the S&P 500 index vis-a-vis that ETF. So the transaction costs would almost be zero, but the direct answer is no, we did not.
a follow-on question then, if I may, and maybe we'll see this, but how, what is the dependence of the Sharpe ratio increase on the rebalancing period? If
It's a good question. We assumed monthly rebalancing, and in fact the entire paper is built on that frequency of rebalancing. I did the only other one I did was daily rebalancing, and what I mean by that is basically the same process, but every day changing your exposure to the market based on the VIX at the end of the last trading day. And my memory was that was substantially better in both regards, better at controlling the level of risk over time, that is keeping it constant, but also better in performance. That is the only other perturbation that I did. Now, my intuition is that that's better because it's just a more recent observation of what the risk of the market's going to be, and that's why it performed better. But that one, I think you probably would want to take transaction costs more seriously.
Thank you.
So this slide is starting to introduce this notion of, okay, now we're going to do the same thing, but not on the entire stock market or the S&P 500, but on different factors in the market. And these are sort of the most popular, I'd say the most popular factors for quant investors. Right now, these being this list of 5 we see in the slide. And this slide is simply documenting the performance of these factors over this very long time period, 1966 to 2019, the end of not last year, but the end of the prior year. That sample that sample size is chosen primarily by a number of things, some data availability, but also just a time when there was in fact 1,000 stocks in the US stock market to the end of the calendar year in which we were doing the research. So what we're seeing here is the first column is the market performance. The market here is now the largest 1,000 stocks in the US market, the Russell 1000. And you see the average return, standard deviation, a ratio. We're not quite want to call that a Sharpe ratio yet. And then the other columns are factor portfolios, and the numbers are active numbers, meaning their returns above and beyond the market return that we see in the first column. This is again this is just redocumenting why these factors are so popular. They all have, as you see, average returns that are positive. And for example, the value factor, 172 basis points is a fairly sizable alpha over that length of time, average active return. Technically, the alpha is down lower. It's 197 basis points after adjusting for a little bit of beta that isn't exactly 1, but it's huge. It's a huge number, and that's why the value factor is popular. And the momentum factor, there's what's called the small size factor. The low beta factor is probably my favorite, but that's because my co-authors and I were sort of the ones that helped discover that. And then there's the profitability factor. So that's their performance, and they're only just looking at this so that we can see subsequently how much improvement we might make in these returns by managing the risk.
And Stephen, real quick, did you calculate your own value factor, or did you just use like Fama French data?
I'm glad you asked. These are our own. They're not from a French. Although they're in the sense that they are now fairly well established methodologies for creating these factors. And in fact, let me, as an aside, I'm sort of pretending that I'm Ken French, and I created a website, and you can go to that website and download these factor returns. I'd like to say they're not just our factors at this point. They are pure factors, and I'll explain what pure means in a minute. And they're benchmark anchored and a few other tweaks. But in the end, there's a simple formula to create these factors so that anybody can replicate them. And the actual returns are available for anybody to download on my website. It's called Deep Creek Deep Creek McConaweep is the name of Zion Park here in Utah, like 100 years ago. Anyway, that's Deep Creek M, and you should be able to go to that website and you can see these factor returns. So the direct answer, these are our version of those factors. Now, let me, and that just maybe, we don't want to get too far afield, but there's a number of differences between these factors and the Fama French factors. There's 2 or 3 more than Fama French have, but the biggest difference is these are pure factors. They're factors that try to be pure in the sense they don't have any exposure to the other factors. They're pure in that sense. They're benchmark anchored. What that means is the factor itself is cap weighted as opposed to not being cap weighted. And then then the value factor is a substantially different definition. It's not book to market. It's based on than the Fama French factor. It's based on the inverse PE ratio or earnings yield. Momentum is a la Carhart, Mark Carhart. Small size is the log of the market cap. Low beta, you've probably heard a lot about that. And then profitability is the one we use as far as the definition is Novi Marks out of NYU is the profitability factor. So let's go to the next slide. This is just a plot of those pure factor performance numbers over this time period. It's, I think until last week with all of the GameStop and the short squeeze mania and everything, probably the biggest news in the market last year was how poorly the value factor did. It has just got everybody that does quant investing, and frankly, almost everybody in the marketplace, sort of surprised how bad the value factor did. That isn't here in this chart because it ends in 2019, not 2020. But if it were, we'd see that blue line at the top dip way down in 2020, and this is the really upsetting thing, not come back when the market came back. Then there's momentum and some others, and it's probably worth mentioning the low beta one here is not like the others in the sense that is a leveraged low beta. The low beta factor on average doesn't have a return that's better than the market. And so this purple line wouldn't be upward sloping. The point of the low beta factor is it has as good as a return as the market. In order to make it look this way, it's a leveraged low beta. I think it's 1.25 to 1 leverage based on the fact that this low beta portfolio has a realized beta of about 0.8. But this is still just performance numbers to set up the risk management process. Let's go on to the next slide, unless there's any questions. Okay.
Can we go back? Actually, I did have a couple things to say, just highlights. One of them is that your value factor, I see, has been flat for a pretty long time, even through 2019, at least according to this chart, which I think makes it look better than other value factors I know of. Is that right?
It is better than the Fama French market, but it is indicative of most measures of the value factor. And so what Lisa's pointing out, I think, was Lisa, that question?
Yes, that's me.
Not only this, the value factor, well, there's a big debate about it actually being dead, and being dead meaning there's no longer any expectation that it will outperform the market. And in those discussions, people are starting to put the death date, rest in peace, maybe back 15 years ago. But it has been flat, according to this chart, since about 2007, 2008. I actually have my co-authors are here, they disagree, I think, but I'm fairly convinced the value factor is dead. I just don't believe, and I thought that a couple of years ago. So yeah, that also is a big deal about the value factor. Besides last year, is that it has not performed well for well over a decade.
I had a second question more related to the beta factor, which is also my favorite factor. So how frequently are you updating the factors? Is monthly or daily? Looks kind of.
This is monthly rebalancing.
So just another point, not central here or in your chart, because you only go through the end of 2019, but the beta factor underwent a revolution in March of last year, which I imagine you followed a huge churn of traditional exposures. And I wonder if there were others along the way that were interesting to you, factor turnover.
No, I remember, as you say it, the fact that there was a lot of turnover on low beta stocks. And in fact, my co-author, Harindra, we actually had a sort of a panic conference call because he was trying to explain why that was happening to clients. That's about all I remember of that. But there was a lot of turnover, and is it true, Lisa? It wasn't just low beta; they all had a lot of turnover, but low beta's was biggest.
Low beta was biggest, but the other interesting elements were communication stocks, like these IP stocks like Facebook, coming down from high beta. It was a big compression, with the exception of energy, which went up. Communication, IT came down, utilities, real estate, and consumer staples went up. And it was a violent kind of churn, which certainly affects this kind of analysis that you're doing. And of course, all the live money around those indicators.
Yeah, in fact, as you say that, it wasn't just, you're right, it wasn't just turnover, it was, well, I guess in the low beta factor, it's turnover that is driven by the fact that the betas of individual stocks changed a lot in March of last year, and then that created the turnover. And now, as I think about it, Harin's big issue or question was, okay, how persistent do we think betas are in typical markets? And can we figure out why it's so non-persistent? In fact, at least that it seemed at that point, we were actually looking at some of your work on betas. That is to answer the question about how much they change over time, how much they typically do, and then why was there so much back then? I do think, and we're getting a little bit off topic, but I think much of that can be answered by just looking at dispersion statistics. That is, if you look at the dispersion of stocks in a given month, if that number is high, then the betas, the realized betas, will change a lot in that month.
Uh-huh. So by dispersion, you mean return dispersion, cross-sectional.
Right.
Wow. Uh-huh.
And
Okay.
in particular, I'm quite keen on the cap-weighted return dispersion.
Uh-huh. Well, thank you for the digression.
Okay. So let's go on. Next slide.
Sorry, Professor, we also have a question from Saad,
Yeah.
if Saad wants to ask the question.
Yeah,
Okay. Let's go to the next slide. Or is there a question?
Oh, he put it in the chat. I'll just ask it for him. It's he asked the same question for the size factor. Is the underperforming part after 2001 not related to tech? And would it still be the same if we control for sector or discarded tech?
I'll answer the question a couple ways. This size factor is literally the log of market cap negative the log of market cap, or the log of 1 over market cap. That's the statement or definition of the factor, and that is the same as the Fama-French factors. When we talk about the size factor, well, as you can see on the chart, it had a huge period of not only flat but down performance, and that was a few decades ago, and that prompted some discussion that the size factor was dead. Then it seemed to resurrect after the turn of the century, but now it seems like it's sort of dead again. The size factor is showing a lot more persistence of performance than the other ones, whole decades at a time when it's going up and down. The size factor, I guess I'm reminded AQR, I was visiting with them, and they basically said, we don't believe in the size factor, or we haven't for a decade or something like that. The size factor is like the value factor, except for now it's died twice in my mind. And I don't know if that's the nature of the question, but I don't believe in the size factor anymore in terms of having a higher average return than, say, a cap-weighted market portfolio. And it is, and I think these charts make that evident, but that again isn't specifically what this presentation is about. So this is sort of a side topic. This is just what those factor portfolios would look like if they weren't pure. And let's just skip over that for now. This is the actual, the mathematics of creating factor portfolios, at least these pure factor portfolios. they are based on a Fama-Macbeth regression methodology that is a cross-sectional regression methodology. And basically, and this is not, again, new to this paper, but it basically says the way to create pure factor portfolios is to use multivariate regression. When you use multivariate regression, by definition, you're isolating the impact of 3 or 4 different variables and isolating it to one coefficient. And so use that same idea applied to portfolio construction. You can create what are called pure factors. And this is the slide that shows how a pure factor is pure. That is, it doesn't have exposure to other factors. This row down at the bottom, a correlation coefficient. If that's 0, that being the correlation of one factor's exposure to another factor exposure cross-sectionally. If that were 0, then this equation at the bottom basically collapses to the equation at the top. But it isn't 0 in practice, and so that's why you need this process of making factors pure. I guess since we're talking about factors, I think the biggest one was, well, there's almost all these factors have some correspondence to each other. And in fact, that changes over time. But my recollection is that the value factor almost always gets stocks with low momentum, negative momentum. And so that's an instance where you really wouldn't even get your value factor performance if you just naively tried to create a value portfolio that didn't have this neutralization with respect to other factors. But let's go on to the next one. It's still not the risk management part. This is the definition of these factor exposures, which I mentioned before. And I guess I'll go out on a limb and say I think my favorite factor is no longer just low beta. I really like profitability. And when I say it that way, I'm just saying in a data mining sense, it sure has done well. Continued to do well last year. If I had to guess, I think we may see the profitability factor replacing the value factor as the dominant accounting-based market anomaly. But let's go on to the next one. So this is the point of the paper. What we're looking at here is the realized volatility of these factor portfolios. It is a 36-month rolling realized volatility number for value, momentum, small size, low beta, and profitability. You can see that risk is very dynamic. It is 3 to 4 times higher in some periods than other periods. It's higher for some factors than other factors. It is definitely not constant, nowhere near close to that. And so the application of this risk management process to these factor portfolios, the intent will be to change your exposure to these factors in a multi-factor setting, to change your exposure to each one of them so that each factor provides a constant level of active risk. Active risk is defined as deviations from the broad portfolio or the standard deviation of your realized alpha. The intent will be to smooth out these levels of risk over time by using that equation that your exposure should be set equal to what you want your risk to be divided by what your risk is predicted to be, or what the risk of that particular portfolio is predicted to be. And so if we move on to the next slide, it is the result of that process, that risk management process. The target in this instance was to, I think it was 4% risk for each one of the factors. It might have been 3%, and then we're going to have to explain why it turned out to be higher than it was intended. But the big point is that the process worked in the sense that we did create a portfolio that had realized active risks that were fairly stable. I think I'll go now and explain, and you can probably tell I'm doing this off the top of my head, but if memory serves correctly, the targeted level of risk here was 3% for each factor. You can see that they all are above 3%. And I believe that is because in this instance, we used a trailing 60-day standard deviation number for each of the portfolios as in terms of the predictor of risk. And it turns out that daily standard deviation numbers, even if you annualize them by the square root of 250, do not predict realized risk with a monthly rebalancing period well. That is, they understate it. And so that's why the levels here are at 4 and 5%. It's because of using a daily return historical risk statistic to try to predict monthly return realized risk. But it worked. It worked. It would have worked historically to try to create a stable level of risk. Let's go on to the next slide, unless there's any questions. I should have just looked at this slide and I wouldn't have to remember. This is showing, this is describing the process. We did, econometricians just love garbage. And there's a whole series of very sophisticated models that are econometrically fascinating. But we didn't use any of those because they don't make that much difference. That's what that first sentence is saying there. We used just, it's really even quite crude. It's just the last 60 trading days, the returns squared, summed up, and square rooted. We didn't even take means off. This at the bottom is then sort of the second reason that this process worked. It worked in that it did level up the amount of risk, active risk that was contributed by each factor over time. But in addition, it improved performance, at least on some factors, and collectively improved performance substantially. Let's look at the next slide. If there were, I've dreamed of doing this for a while. That is, the last time I actually sort of discovered a new equation, and just discovering equations that actually mean something and might be used is kind of a pretty heady process. The last time I did that was the transfer coefficient, which is used to measure the impact of constraints in portfolio management. But this may be my second equation. It is a simple equation whose intent is to say what the weights of a portfolio should be on the left-hand side based upon different risk parameters and beliefs about factors within that portfolio. It is, we don't generally care much about closed form, simple algebra solutions anymore, because who cares? We're all going to put in a computer anyway, and computers can do numerical searches so fast we wouldn't know the difference. But there is value in, I think, in having an equation in that then you can do a number of things. You can do first derivatives and do comparative statics, and it just provides more intuition and understanding. But that, anyway, this is an equation that represents a multi-factor risk-managed portfolio, and the weights that would be in that portfolio. In this instance, it's just two factors to make the equation simple. The underlying IR, and which means information ratio, IR squareds, and the fact that you take the square root of the sum of squared IRs goes back to Granold and Kahn, both there in the Bay Area, and their work in what we have called now subsequently the fundamental law of active management. But this has some other risk parameters in it, and that you can see the point here that sigma sub c is the targeted level of risk, and then you're putting those sigmas in the denominator on a factor by factor basis. That's very much like that risk management conceptual equation we saw at the beginning. You would put in your targeted level of active risk as the sigma sub c, the predicted level of risk of the factors as the sigma 1 and the sigma 2, and then let this equation dictate the weights of a actively managed portfolio. Let's go on to the next slide. This is all the matrix algebra that underlies that equation. The matrix algebra isn't particularly intuitive. It's just ugly, but that's what it would look like. Down at the bottom there, maybe something that's a little more fundamental, and that is that this process can be divided into two parts. One is how you put securities into a factor portfolio, and that would be the creation of these pure factor portfolios. But the second part then is, and then how do you allocate your total portfolio to different factors? And that's this second part of the equation. And it's that second part that we're doing the risk management on. We're adjusting our exposure to factors based upon how risky we think they're going to be. Let's go to the next slide. More just on the math. I believe, and it's an assertion in the paper, that we are doing nothing but good old-fashioned mean variance portfolio optimization. But now we're doing it on factors. Markowitz talked about doing that on individual stocks. We're doing it on factors, and you'd say, well, why wouldn't somebody else done that? And the answer is because you do have to ignore idiosyncratic risk. And once you do that, this very, very complex mathematics actually kind of all resolves itself, and you get these nice, simple, sort of intuitive equations. And the justification for ignoring idiosyncratic risk is we're going to put all this into portfolios anyway, so we don't care about idiosyncratic risk. Let's go to the next one. Next slide. These are the resulting exposures over time to these factors. That is, in order to manage the risk, we lower exposure when we think the risk of that factor is going to be high, and we increase exposure when we think the risk of that factor is going to be low. So, for example, you see the value factor for most of the last, well, since maybe about the 1980s, has the highest exposure. It's because the value factor by its very nature has less volatility. So in order to balance the volatility of that factor with the other ones, it gets a higher exposure. But more importantly, the exposure changes over time in response to risk. And then in real time, all of this stuff that's got exposed biases in it, but kind of in real time, you adjust at the end of every month your exposure to the factor. You just adjust down if the factor is signaling that it's going to be very volatile, and you adjust up if you think the factor is not going to be very volatile. And then we see this pattern over time. So these are the exposures, is the point of this chart. Let's look at the next one. And these are the results. That is, at the very bottom, these information ratios for the factors are, these information ratios for a multi-factor portfolio they're huge by, I wouldn't even dream we'd get that this big of a number going forward. But the first column, what it says down at the bottom, 0.820, would be a simple equal mix of 5-factor portfolios that aren't even pure, and are not risk managed. And that 0.820 is the information ratio of that portfolio. And then the next one is, okay, what if we make the factors pure? Then the information ratio goes up to 1.137. What if also we risk manage them? And actually, the next one is, and what if we combine them in sort of an optimal fashion? Well, 1.179. And then the last one is many factors mixed in the right proportions, and then risk-based timing. And timing is almost a naughty word but in many contexts in terms of portfolio management, but that's what it is. We're timing our exposures based on what we think the risk is going to be. And you get an information ratio that goes up to 1.253, which is, again, enormous. The things at the bottom are to try to measure with this trainer black rule how big of an impact each step has.
Can I ask a question? In the mean variance optimal column, how are you estimating the covariances among the factors? When you look at the pure factors, so those are intended to be uncorrelated, is that right? Or
that is correct.
over what period of time?
It's using the let me answer the question you asked, and then I'll go back. And
Okay.
these because these are pure factor portfolios, we're assuming they have perfect zero correlation going forward. And so the formula doesn't take correlations into account.
Okay.
Now, the realized correlation in any given month, or I should say on monthly rebalancing between these factors, does tend to be non-zero. It's some small number. The way the portfolios are constructed to at least intend them to have no correlation to each other is to take the exposures at the beginning of the month for the various factors, look at how they correlate, and then adjust based on the historical correlation of those factors in order to get to adjust to a current ex-ante uncorrelated factor portfolios. Is that answering your question?
I guess so. Are the details of that in your paper?
They aren't so much in this one as they are in the prior paper in the JPM. It's called Pure Factor Portfolios and Multivariate Regression Analysis. And then the details are, yes, very much in there. But that is conceptually what's happening is that portfolios are intended to be pure and uncorrelated with each other So we assume in the multivariate portfolio construction that they are perfectly uncorrelated.
Okay, thank you.
Let's look at the next slide. So these are a couple of regressions, and I was a little hesitant to put these in the paper because these kinds of regressions to measure long-term performance have built-in bias in them, ex-ante bias. That is, they go the full sample and they, more so than other things we typically do, they kind of assume you knew the answer at the end before you started. And so I'm not too keen on them, but what they are intending to do is, in the more traditional accepted methodology, demonstrate what the alphas of these multi-factor portfolios would have been. And the 262 alpha, 262 basis point is one way of measuring just how much more valuable it is to use pure portfolios rather than primary or portfolios that haven't been neutralized with respect to the other factors. And it's only the 79 basis points at the bottom that's based on the actual risk management process, that is adjusting exposures. But it is big enough. One way to sort of capture this as far as an advertisement, I suppose, is that this risk management process adds about as much economic value as any of these factors did alone historically. And that's a pretty big improvement in economic terms rather than just statistical terms. Let's look at the next one. This is now an example of this formula. It's just plugging the formula into a spreadsheet and examining how it worked. Much of what's here is just confirming the mathematics, the ex-ante mathematics. With a particular example, it's the beginning of October 2019. This portfolio is being adjusted to an active risk of 3%. You can see the forecasted risk of the factors, forecasted returns, the resulting exposures, and the portfolio ex-ante IR is exactly what the math said it should be. In this particular numerical example, it's 0.8. That's an IR, information ratio. So that's measuring value added above and beyond the Sharpe ratio of the benchmark. Let's look at the next slide. This is an actual. I think we don't do this enough in publications, but it's an actual description of the portfolio at one point in time, and with at least the first 20 or 30 stocks listed as far as sorted by their weight in the market, and then what their weight is in this portfolio. It is perhaps ironic that the biggest negative weight, and a negative weight on the right-hand side, I'm looking at Berkshire Hathaway, BRK. A negative weight here actually means a short sell, but the biggest one is, well, it's ironic that it's Berkshire Hathaway.
Got another question here. Do you have any thoughts about how a long-only constraint might have affected your result?
Yes. Mm-hmm. Of course, I'm keen on the transfer coefficient, so yes. What we're looking at here is an optimized portfolio without a long-only constraint. And a big emphasis in the paper is that in the real world, almost all portfolios are long-only. So Lisa's question really is next, and that is, okay, what if you didn't have any short sells? What would happen if you just took the negative weights here and set them to 0 and resized all the other weights to sum to 100. That's a heuristic, and I reluctantly put that into the paper because it is heuristic. Part of the notion here is no, everything here is mean variance optimal, formula driven. We're not doing rules of thumb, but we have to, it turns out, to get a long only portfolio, and then we subsequently measure the impact of that with the transfer coefficient. Let's look at the next slide. There's my, so that's yours truly, and I've got Warren Buffett with his hand on my shoulder. I thought that was a pretty, that was a coup. But you were sort of scarily non-diversified here, just a bunch of white guys. But it was back 15 years ago. Anyway, I had a class where we went out and visited Warren Buffett and he was kind enough to take this picture afterwards. And the reason I have it here is because of this kind of oops as far as saying let's short Berkshire Hathaway in that particular example. Let's go to the next slide.
A quick question. I thought you'd said at the beginning that you traded ETFs. Is this portfolio made from single stocks, or are you computing the single stock representation through ETFs?
It is single stocks. That reference to that is, we're creating these portfolios from individual stocks. The reference to ETFs was in the market risk management example, which used VIX. But otherwise, no, these are not ETFs. These are from individual stocks.
Thank you.
But it is, well, yeah. So this is the I'm embarrassed here. We get the ego thing going. The I've forgotten in this presentation. This presentation was an internal presentation to the staff in Los Angeles. But anyway, I named it the Thorley coefficient down there at the bottom. But that is the transfer coefficient, and what it's measuring is how much distortion there is in this portfolio when you do this long only heuristic, and the answer is almost none. The transfer coefficient goes from 1 to 0.996. That's a specific month, October in 2019. That number would change over time, but it's always economically inconsequential, I guess is the way I'd say it. And I think the next slide will actually give us something on transaction costs, which was talked about before. This is, well, it's probably conceptually important that statement that the distortions due to this long-only heuristic are immaterial is true at standard active risk levels of 2 or 3%. It's not true if you got as active as, say, a 6 or 7 active risk portfolio. Then you're starting to get transfer coefficients and levels of shorting that are deleted in a long-only portfolio that become a little more material. Although, kind of in a long-term perspective, even transfer coefficients of 0.92 are fine compared to what we used to experience when we imposed long-only constraint. Let's go to the next one. I think that will have transaction costs. Here's turnover. The turnover of the various factors is there. The momentum factor has the highest turnover because it changes the most from month to month, followed by low betas. Lisa was saying that this is an average over time. that low beta number back in March of 2020 would have been much higher, but this is the average over time. And then that's the turnover of the stocks within these portfolios. I think it was Robert was asking this question. This is turnover of individual stocks in portfolios. And then there's even more turnover as you adjust exposure to the portfolios. And you end up with this number down at the bottom is 23.6%. We then take that turnover number and apply an assumption about transaction costs. It's not a real transaction cost simulation. And then basically come up with the conclusion that the transaction costs would probably cost you about 20 basis points a year. That's 20 basis points a year in today's markets, meaning you're trading with almost no bid-ask spread. These are major large cap stocks, no commissions, that kind of thing. Let's see the next slide. We may be done. I think we are. We focused mostly on the risk management process here, the intertemporal risk management process. That's point number one. And then the other points are, well, number two is just the simple market example that anybody could do as an exercise for the reader. Number three is not the process works. You can level out the risk of an actively managed portfolio over time by adjusting exposures. And then four is, and it turns out that not only do you level the amount of risk over time, but you add value, substantial, almost to the point of another equity factor. I think that's it. I don't know if we have time for questions, but I'm perfectly willing to stick around for questions.
We do have time for questions, a full 12 minutes. So I've asked quite a few, and Bob's asked some, Saad has asked some. Open it up for others. Maybe people are a little shy at the beginning here. I have one more. You mentioned a prior paper, Stephen, in Journal of Portfolio Management. I see that we have a link to your current paper on our website. Is there any way of getting a copy of the previous paper that we could circulate to this group?
I could just send it by email like I did before. The JPM is a little more, Frank Bovozzi is a little more persnickety about that, but the name of it is, it starts with pure factor portfolios and multivariate regression analysis. But I will do that. And in fact, as you say it, in the end, I think that is the JPM published the paper, but didn't publish two technical appendices. And one technical appendix is specifically the math behind creating pure factor portfolios, basically a recipe. I'll send you all those by email.
Right. Yeah, I'm familiar with the JPM publication rules, so we'll be sure not to post links. Love to have your technical appendices, and we can dole them out by email on request. How about that?
Okay. Yeah, I think.
All right.
Copyright wise, I really don't know, but I think given that I'm one of the authors, I can do that.
Okay, well, last chance on questions, guys.
I have just a quick question. Thank you very much for the presentation. Would actually sector make any sense in the control process for those factors in particular? Because like some sectors have like higher like value factor or so on.
The direct answer is in this paper, no, there is no control for industry composition or sector composition. That is, the pure factor portfolios are taken as given, as dictated by the factor exposures. And so some periods, the value factor may have higher exposure to retail than other periods. So the direct answer is no, although it makes me think about that prior paper again in the JPM. In that paper, we did, as an additional experiment, creating portfolios that were pure, not only in terms of exposure to other factors, but were industry neutral. It's just a process of extending the mathematics out, putting in dummy variables for industry, and then making each of the portfolios have the same industry exposure as the broad market. And it makes a difference. You would get then portfolios that are, you could say, not only pure with respect to the other exposures, that other well-known factors, but also that have a constant exposure to the various sectors or industries. I think it was 2-digit SIC codes that I used. Those portfolios would be pure, factor pure and industry pure. And it turns out that improves performance a little bit as well. But that's all in that other paper. In this paper, the pure factor portfolios are not industry neutral.
Thank you very much.
Yeah, it makes me, I guess I'm tempted to pontificate on that other paper. You could almost envision, well, here, this would be the process, is you simply, you wouldn't have to put it as a dummy variable. You could use GICS industry data that has each company parsed into sort of how much of the company is in different sectors. But one way or the other, it's just a matter of adding new factors. Instead of 5, you've got 5 plus, I think we ended up using 2-digit SIC codes, and that would be another 25 industries. So instead of 5 factors, you have 30 factors. And then you have portfolios that are pure, both with respect to exposures and also industries. And interestingly, you get industry portfolios that are sector portfolios, like the financial sector, that are pure with respect to factors. That's just an extension of this pure factor portfolio mathematics.
Thank you.
That makes me also think, and it really is almost inexcusable now, this day and age, but of course, this is all just on the US market. But the methodology of creating pure factor portfolios, managing their risk, could be done in any country market, or for that matter, the world equity market. We didn't do it just because the CRISP and CompuStat data is free to me as an academic, and the broader data sets are not. But one of my hopes is that somebody will take this research and apply it to broader equity, either the world market or other country markets. And you can maybe publish a paper on that.
If you added a consumer staples sector and also had a value factor, wouldn't you risk multicollinearity?
I think the answer is you have multicollinearity in the fact that there is a correspondence between, say, a specific industry portfolio and the value factor, but not once you've made them pure. That is, once you've designed those portfolios to be independent, if you then put the realized returns in a multivariate regression, you wouldn't have much multicollinearity. I don't know if that's what was being asked, but that's.
I just wonder about the error in the multilinear regression.
The error in what sense? That it's biased?
Well, if you have two perfectly correlated regressors, you can't really trust the coefficients.
Right. I think, well, I'll answer it this way. Yes. Although we haven't observed in the actual historical record any correlations that are high enough to cause material multicollinearity in the creation of these pure factor portfolios. I certainly could be. And if you started to move to different country markets, and off the top of my head, I'm thinking Finland and Nokia, for example, yes, you could have enough multicollinearity in the regression that informs the creation of pure factor portfolios that would be problematic in terms of using the coefficients to infer weights.
Exactly.
But I guess I'd put a little caveat on it, and that is that we're using the regression mathematics in that context not to do a regression, but we're using the underlying mathematics to create a portfolio. And in that sense, it's definitional. That is, we're only borrowing the mathematics of multivariate regression analysis, not actually doing a regression. And so one could say, even if it was Finland and Nokia and telecommunications, that let the coefficient be whatever it is by definition the pure factor portfolio for that country and that industry in that case.
So you would trust the pure portfolios you got without regard to the issue of the any regression errors?
I would in the US.
Thank you.
Yeah, I would in the US, and also I would because this entire process is cap weighted. So all these regressions, everything, one of my big preaching points is that all cross-sectional statistics about the market nowadays should be cap weighted, not just means, standard deviations, correlations, everything. And I could pontificate as to why I think that's so, but because of that, you're really, you could think about a multivariate regression that is weighted, cap weighted, and you're not going to get any of these perverse multicollinearity impacts when you're focusing on the larger stocks.
Thank you.
Yeah.
Okay, well, I think we're ending here on a fantastic point that I hope we can continue sometime in the future on how to weight regressions. Really appreciate those last comments. I'd like to thank you all for joining us today. Next week, we're going to be, special thanks to our speaker. That was a really perfect talk for us. Beautifully clear and illuminating and also very practical. So can't ask for more. Next week will be something completely different. David Ritzwaller of Stanford will be telling us about statistics of related to a subject dear to another subject dear to my heart, which is basketball statistics and questions of whether we do or do not have hot hands in data. So hope you'll join us then. And between now and next week, stay safe out there, and look forward to seeing you next time. Thanks very much.
Bye-bye.